Hey there YouTube. So in this video I wanted to cover Schedule C that is included with the Form 1120 U.S. Corporate Income Tax Return. So I have an example of a Schedule C and the Form 1120 in front of us here, but I've also got a slide that we're going to go through with some of the rules and then an example fact pattern, and then we'll flip back to the form itself. So starting with some of the basics, Schedule C, it's titled Dividends, Inclusions, and Special Deductions. And this schedule must be included with every Form 1120, okay? So Schedule C is basically part of that standard Form 1120 package. Every 1120 that's filed needs to have the Schedule C, even in cases where it's blank, okay? And you might have no fields completed. So you could have all zeros, still need the Schedule C, right? So the standard 1120 always includes the following schedules. It has page 1, obviously, that's always necessary. But then the pages 1 through 6 include Schedule C, J, K, L is the balance sheet, M1 for the book to tax differences, and then M2 for a reconciliation of the equity. So these are a must-have. And that's in contrast to some other forms and schedules where you don't have to have them unless there's some other kind of income item or inclusion or something else going on where you need to include it. Okay. So what is Schedule C used to report? Generally, you're using it to report dividends, certain kinds of interest, and other forms of pass-through earnings from companies that the corporation has an equity interest in. Okay, the equity interest can range anywhere from 0.001, so less than 1%, up to 100%. So that would be a wholly owned subsidiary. If you have any kind of income coming from the sub or that entity that you own a 1 or 2 or 3 upwards of % interest in, you might have to disclose that information on Schedule C. And what we'll see here is in many cases it's beneficial to do that because you can get special deductions depending on the tax structure of the entity. Okay, so let's look at a very simple Schedule C disclosure. We have two basically subsidiaries, if you want to call them. Well, not really. Two equity ownership interests of the corporation where we need to complete Schedule C, and you'll see the benefits that are provided if you complete Schedule C because you get a deduction for the income. So our company is going to be Fake Consulting Business Inc., right? So this is our company. It's a Delaware corporation, taxable as a C corporation for federal income tax purposes. Now, the company owns $250,000 worth of publicly traded stock of a U.S. corporation, and the company's ownership percentage is less than 0.5%, right? So it's a nominal interest because it's a publicly traded company. It's huge. So it owns $250,000 worth of stock, and during 2020, the company received $15,000 in dividend income from that stock. Okay, we have to include $15K in dividend income on Schedule C, line 1. And it's also included on page 1, line 4 of the company's 1120. So if we flip really quickly to Schedule C, so the amount that we just talked about was line 1. Dividends from less than 20% owned domestic corps. Okay, so we have a $15,000 dividend inclusion. That's what we actually got. And then column B and C. So column B represents the dividend received deduction that we can take on the dividend income. And so in this case, for less than 20% owned corps, you get a 50% DRD. So it means our deduction is going to be $7,500. And you'll notice if we scroll down column B, there's a variety of DRD amounts depending on what type you have. We'll talk about these other ones briefly later, but right now we're focusing on the top 2 because these are the most common. Okay. Let's go back to the slide. Okay, so for the second piece, we have the company is also a 40% owner of a Wyoming corporation that is also taxed as a C Corp. So this is a corporation that's not publicly traded. It's closely held stock. The Wyoming Corp distributes a dividend of $50,000 during the 2020 tax year to the company, and the company reports a dividend income of $50K, line 2 of Schedule C, and then again, the $50K is included on page 1, line 4 for the company. So if we go back to Schedule C, we have the $50K here, right? This is dividends from 20% or more owned stock, right? So again, we own 40% of a domestic corporation in Wyoming. So the dividend income we get from that entity is reported here on line 2. And the DRD is going to be 65%, which equals $32,500. Now these two amounts, the dividend inclusion, this is included in gross income. We have $65,000 here. And when I keep referencing page 1, what I'm talking about is this. Page 1 of the 1120, we have, the gross income from the company. And here's where we're getting our dividend income. $65,000 reported on line 4. That's the piece that is pulling from Schedule C. Okay? So Schedule C, we have our dividend income inclusions. We have the DRD amounts depending on our ownership percentages, and we have the special deduction. So everything at the bottom here foots to $65,000 in gross dividend income, and we have a $40,000 special deduction. Okay, so let's talk about that special deduction a little more. Okay, so going back to the DRD, dividend received deduction, or DRD, is designed to try to eliminate double taxation or even triple taxation for companies, right? So you're familiar with a corporation pays tax at the corporate level, and then when the dividends are distributed to the shareholder, they pay tax at that level. Well, when you have a corporation that owns stock in another corporation, you have potentially 3 levels of tax, right? So in this case, if we go back to this first piece here, fake consulting business, the publicly traded company pays tax at its level, and then it distributes a dividend to fake consulting business, which has to record an income. And then after fake consulting business pays tax on the income, it can again distribute it out into a dividend to its shareholders. So you have potentially 3 layers of tax in these 2 fact patterns right here. In order to try to eliminate that, or at least alleviate it, the corporate structures are allowed a dividend received deduction. So you can deduct a certain portion of the dividend and not pay tax on it, so you're not getting just absolutely hammered with corporate income taxes at multiple levels. Now, there are certain provisions that allow for a 100% DRD. You'll notice here we have a couple instances. We have dividends from wholly owned foreign subs, domestic corps under the Small Business Investment Company, Small Business Investment Act, and so on and so forth. So there are certain types of dividends that could be completely exempt under the DRD provisions, and then others, like the examples we're looking at, you get a DRD, but it's not 100. It's 50 and then 65. So there is some help there, but not much, maybe. So I think that covers it for the. Oh, let me just touch on page 1. Sorry. So you can see how this all turns out. So again, we have the $65,000 in dividend income included here on page 1, form 1120, and then the DRD special deduction is on line 29B. So we've got our total taxable income $684. We can back out $40,000 worth. So our taxable income on line 30 is $644,000. And again, that $40,000 is our special deduction from the dividends received deduction on Schedule C, right? So that's the amount that we're seeing from here, right? Line 24 on Schedule C, the $40,000. Okay, so that covers it for Schedule C. Fairly straightforward, but very, very important, as I've highlighted, right? If you've got a C corporation that's invested in other C corporations, whether they're domestic or foreign, you could have DRD inclusion, or you could have DRD exemptions to try to reduce that taxable income, which is obviously ideal. We're trying to eliminate double and triple taxation of earnings. So very, very important to complete Schedule C where required. But again, as I highlighted earlier, a lot of companies have to include Schedule C, but very often these columns are completely blank. You could have a Schedule C for Form 1120 where they don't have any dividend inclusions from any other companies. And so that's fine, right? There are just all zeros down here and there's no special deduction. But if you find yourself in a position where you have investments in other C corporation entities, you're going to have to complete this schedule to make sure that you're maximizing your deductions. Okay, so that covers it for this video. Thank you for watching. If you have any questions, please leave me a comment below, and I look forward to seeing you again on the next video. Thank you.